So I made a huge mistake with Palantir, and you probably did too. Why though? What mistake could I have possibly made with Palantir? I mean, don't get me wrong, I'm still bullish on Palantir, and I think their business is growing, and I think it's thriving. But what about Palantir stock? That being that Palantir is a growth company. And if you've been paying attention at all, growth stocks are getting hit pretty hard right now. I'm talking like 30, 40, 50%. So the mistake that I made, and a lot of other people have made, is that they're overexposed to risk. Now, before you click off the video, don't do that. I know risk sounds super boring, but it's very, very important. And you can trust me on that because I'm a stats major. So let's get into why this is a bad thing and how you can avoid it in the future. So let's get into the first point. If you're heavily invested into growth stocks, your portfolio is undiversified. Now, I don't mean if you have a portfolio made up of 50 different growth stocks that you are undiversified. But if you only have one or a few stocks and they're all growth stocks, you're undiversified. Your portfolio is at the mercy of those 3 or 4 or 5 stocks, and if they go down, your whole portfolio goes down. And this is a risk that is amplified when you're investing in companies that are not cash rich. Now, what do I mean by cash rich? Well, if you look at the balance sheet of Apple or Google or Microsoft, they have billions and billions of dollars of cash that they have on hand to get through tough times like this. Now, with Palantir, this isn't really the case. They have a decent amount of cash on hand, which you can see on the screen here, but they just simply don't have as much money as Apple, Microsoft, Google, and companies like that. So anytime the market takes a downturn, these are the stocks that are going to be hit the most. Well, the solution is kind of boring, admittedly, but it's to invest in cash-rich companies that can afford to go through downturns like this and aren't going to be hit as hard as companies like Palantir. So this was my problem. I was over-leveraged in Palantir. I had almost $1,500 in Palantir when my entire portfolio was only about $8,000 or $9,000. Now, during the good times, this was great because Palantir shot up like crazy and my portfolio grew a lot. But in times like now, my portfolio is down pretty badly, and it's mainly thanks to Palantir. So that's the first point. Don't over leverage yourself in risky investments. So let me offer a more fun solution, and that's to figure out what exactly your risk tolerance is. Now, what do I mean by risk tolerance? I mean, so depending on your age and depending on your financial situation, what kind of companies are you going to invest in? How much risk are you going to take? And how much are you willing to lose? So with a company like Palantir, maybe you can consider that to be 5% of your portfolio. Maybe that's a risk you're willing to take. If you lose that 5%, you're not going to be that much worse off than you were before. But if it does go up, that's great because you have a decent sized chunk of investment in there and it's going to go up with your portfolio. But in my case, having like 20% of your portfolio in Palantir just simply wasn't a good idea. Now, I should have known better, but I got a little bit greedy, and I think this is a lesson that both I and a lot of you guys can learn from as well. But overall, I think you just need to weight your portfolio more accurately. Now, with good companies like Apple and Microsoft and Google, who just have tons of cash and they're increasing their revenues like crazy, I think that's where you can afford to take a little bit more money and put those into those better companies. But when it comes to growth stocks like Palantir, consider sizing down the amount of money that you have invested in them and don't over leverage yourself. Now, if you're a teenager and you only have a few $100s to invest, and you don't really care whether or not you lose it, sure, go crazy. But if your plan is long-term wealth, I don't know if that's the best strategy. Because when you invest a ton of money in there, you always have the risk of losing it all. So hopefully you keep this advice in mind the next time you go balls deep in a small cap company. Watch this video next because YouTube thinks you're going to enjoy it. Thanks for watching.